If you're interested in buying a home, there are some mortgage terms and acronyms used in the mortgage industry that may be unfamiliar to you. Mortgages can be confusing at times, so today I'm breaking down a few of the more common lingo we use with the hopes that as you approach home ownership, you'll have a better understanding of the terminology. All right, let's get right into it. Pre-qualification. This is the starting point. This is where you're going to complete the loan application. You're going to provide your documentation to the lender, and they are going to review all of that and determine if you are eligible for a home loan, and then put together a strategy of which home loan that would be best for you. DTI, debt to income ratio. The lender is essentially going to look at all of your debts versus your income, and they're going to come up with a ratio. Each loan program is going to have a maximum debt to income ratio allowed to qualify. Let's say that your total usable income, the home loan, is $6,000 a month, and your proposed house payment is $2,000, and you have $1,000 between credit cards and a car payment. So in total, your monthly expenses or the debt in this scenario would be $3,000. We're going to take that, divide that into your income of $6,000, and that's going to tell us that you have a 50% debt to income ratio. Annual percentage rate, or APR. This is the total yearly cost of a home loan stated as a percentage of the loan amount. And what's interesting about an APR is it's not actually the note interest rate. The APR is going to be calculated a little bit different. It's going to include that note interest rate, the cost of the mortgage insurance, and certain closing costs. Not all of them, but some of them are calculated into the APR. In most cases, the APR on your home loan is going to show a higher percentage rate than the actual interest rate on the home loan. Interest rate. This is the cost that you are going to pay to take out the home loan. That's how it looks. So this is just the cost of borrowing money. So let's say today the interest rate is 6%, and you are paying 6% to take out that home loan, or whatever the going interest rate is. It works like interest rates on credit cards or car loans. You're paying a fee to borrow money. Fixed rate mortgage. This is a mortgage in which the interest rate does not change during the life of the loan. This could be a 5-year fixed rate, a 10-year fixed rate, a 15-year fixed rate, all the way up to a 30-year fixed rate. Adjustable rate. In this scenario, the interest rate is going to change at some point in the life of the loan. The most common adjustable rate loans are fixed for a period of time. Let's say they're fixed for a 3-year period, or a 5-year period, or a 7-year period, but after that initial fixed rate period, they're going to adjust based on the loan terms. Rate lock. This is referring to your interest rate getting locked in. Now, when in the process does that happen? Generally, it's once you've identified a home, you're under contract, and you know your closing date. At that point, the lender is going to talk to you about locking in or securing that interest rate. And that is going to be a written agreement guaranteeing you that if you lock in on, let's say, a 30-day lock, that interest rate is going to stay with you for 30 days. Now, interest rates expire and, let's say, exceed that 30-day period, then your rate is no longer locked in, and you'll need to talk with your lender about what happens at that point. The interest rate lock is a written agreement for a specific period of time. Very important to know. Down payment. This is the portion of the purchase price that is required based on the home loan that you are using. For example, if you are using a VA home loan, VA does not require a down payment on most of their loans, so you would not have a down payment. However, most financing outside of VA does require a down payment. FHA requires a 3.5% down payment. This is a percentage of the purchase price. If you're purchasing a $100,000 house and you are putting down 3.5% down payment, then that's $3,500 of $100,000. So the down payment is the required amount that you have to put down based on the home loan you are applying for. Closing costs. Closing costs are a very broad term, and they encompass a lot of different fees that are associated with purchasing or refinancing a home. When we think about a purchase of a property, the closing costs can include things such as lender fees, the title company or escrow company fees, the first year of the homeowner's insurance, escrow impounds if you're escrowing, meaning that the lender is collecting for your property and taxes and homeowner's insurance every month, so the escrow deposit. They'll have days of interest depending on when your closing date is, so all of that is included in closing costs. Oh, and by the way, appraisal. An appraisal fee is a closing cost as well. Some states or cities have transfer taxes, survey fees, but all of the costs that are needing to be collected, not all lender related, but costs themselves in relation to purchasing buying a home, all of the costs that must be satisfied when you purchase a house are included in that closing cost category. Principal and interest. When you see things online, whether you're doing a calculator or you're talking with a lender, or you're just trying to get an idea of what a payment is, a mortgage payment consists of two primary pieces. One is going to be a principal and the other one is the interest. And depending on the amortization, it's important to know how much of your payment is going towards principal and how much of that is going towards interest. So if you're taking out a 30-year fixed rate loan, primarily in the first 5 years, the majority of that payment is going to interest because it's amortized for so long. However, if you are taking out a 5-year fixed rate or a 10-year fixed rate type of amortization, then more of your monthly payment is going to go towards the principal. What is principal? Principal is your money. It's your savings account. It's how you're building equity or wealth through your real estate that you've leveraged by taking out a home loan. So every month, if your payment is, let's say, $1,500 a month, and I'm just using this as an example, and let's say that was a 30-year amortization and maybe you're 1 year into that 30 years, out of that $1,500, roughly $1,200 might go towards your interest and $300 might go towards your principal. That principal is your money. Again, that's how you're building equity in your property. It's like a little savings account. You're prepaying yourself. PITI stands for principal and interest, taxes, and insurance. If you're putting less than 20% down, most home loans are going to require that they escrow for property taxes and homeowners insurance. Thus, when you look at the payment on your mortgage statement or the payment online that you're running a calculator on or what a lender is telling you, it generally is going to be a PITI payment, meaning principal, interest, taxes, and insurance are all included in that figure. Appraisal. An appraisal is a professional opinion of the market value of the property. Very important to know that it's subjective and it is based on a point in time. If you're purchasing a house today and that purchase price is $100,000, then the lender is very likely going to document the valuation of the property. It could be more than $100,000, it could be less than $100,000, or the price that you're paying for it. So most lenders and most loan programs are going to use some type of professional opinion of the market value of the property. In most cases, that is done with an appraisal, but not all cases. There are other ways that some loan programs allow lenders to document the market value of the property. Escrow. Escrow is one of those words that's confusing because it has two different meanings depending on the context. When you're purchasing a house and you have an accepted contract, your real estate agent is going to ask you for earnest money. Earnest money are going to be good faith funds that you are going to deposit with the escrow company. The escrow company is a third-party entity and they're going to hold all of the money. So they're going to hold your earnest money. When you get closer to closing and you send your closing costs, the remaining portion of your down payment, etc., that doesn't go to the lender, it goes to the escrow company. When a lender funds and sends the money for your home loan, that is again going to the escrow company. They're a neutral third-party entity that hold the monies that are involved in being exchanged in a transaction. The other way escrow, that term, is used in the mortgage lending process is for property taxes and homeowners insurance. A lender, if they're collecting for those two items as part of your payment, they're going to deposit those monies into an escrow account, and that escrow account is like a little savings account. So every month as you pay your payment, the portion of your payment allocated towards property taxes and homeowners insurance is deposited into that escrow account, and it grows over time. And when property taxes come due and homeowners insurance comes due, the lender pays those out of your escrow account to the appropriate parties on your behalf. Mortgage insurance. There's two types of mortgage insurance depending on the loan type. Private mortgage insurance is relevant for conventional home loans, and mortgage insurance premium is for FHA loans. But mortgage insurance essentially is you're putting less than 20% down. The lending guidelines are going to require that you carry some level of mortgage insurance, and that insures the lender in case of default. But it also allows and incentivizes lenders across the country to lend with lower down payments. So without mortgage insurance, it's very likely that we would not have down payments that are as low as 3 and 3.5%, which is what we see today, because lenders wouldn't have that insurance and they would require larger down payments. Homeowners insurance or hazard insurance. These terms are used intermittently throughout the process sometimes, depending on the lender and the state. Essentially what they are is homeowners insurance is insurance that you are going to select your insurance company to work with, and they're going to insure the home in case something happens to the house. Now you've got insurance, so the lien can be paid off and you can rebuild or whatever it is that you need to do. But homeowners insurance is a protection for you, and that differs from private mortgage insurance, which is a protection for the lender. Home inspection. Once your purchase contract has been accepted, your real estate agent is going to talk with you about next steps. Generally, that will include a home inspection of some sort. Home inspection fees vary. Your real estate agent will be able to give you guidance and recommendations on who they use and why. And that cost is normally paid up front and not at the final part included with your closing costs. So that would be an extra fee that you just need to be aware of. Most loans do not require that you have the home inspected, but it is a best practice and advice. That way, you know, is there anything glaringly wrong with the house? At least you know it up front prior to continuing with the purchase contract process. Home loan closing. Wow, that was a lot. Are you still with me? I know we've covered a lot of the more popular mortgage terms, and I really hope this helps. Check out the description below for a list of videos that go in depth on some of these topics, and of course, subscribe for even more home loan education. If you're interested in seeing if you pre-qualify for a home loan, the Kelly Zitlow Group is here to help. Click the link in the description below to schedule a 15-minute strategy session with one of our amazing mortgage advisors. In the meantime, watch this video on how to get pre-qualified for a mortgage.